Should you sell business assets or should you sell business shares? I normally tell business owners that they should be selling the shares of their business to get the best results for themselves. But in this video, I'll be telling you why I'm selling one of my businesses, and I'll be selling the assets of the business instead of the shares. And we'll also go over exactly when you should consider what situation. So when you're selling a business, you have two options: selling the business assets or selling the business shares. The main difference is when you're selling the shares of the business, you're selling the actual stock in the business, you're selling the share capital of the business. When you're selling the assets of the business, you're taking the assets from within a business and you're selling those to a business buyer. And the reason why you should be selling business shares instead of business assets is because when you sell the shares, you are selling everything. You are selling both the assets and the liabilities. You're selling the entire history of the business, the bank accounts, the contracts, everything that goes within those that business of your business, that just transfers over automatically via the transfer of the shares of the business. And selling the shares of the business usually has better tax benefits as well. So especially in the UK, I mean, there is business asset disposal relief, which is reducing, meaning in fact the tax is getting higher and higher, and it will go in line with CGT over time by next year, in fact. But it's still better than selling the assets of the business. And the reason is because when you're selling the assets of the business, it's considered income into the business, and then you charge corporation tax accordingly into the business. And then, of course, corporation tax is 25%, 20 to 25% in the UK, and then you have to pay tax on that, and then you have to take a dividend thereafter. So there's further taxation. When you're selling the shares of the business, you just sell the shares directly, and you pay a tax one time as an individual because you're selling the entire company. But the reason why in this instance I'm selling the assets of the business, number one, we have a business, or I have a business, in which it's really just been making a little bit more money than break even for a couple of years now. And although it's paying its way and it's doing its thing, I've got other businesses, alhamdulillah, which are a lot more profitable, and we have a lot more control over the outcomes of how we can control that business and actually improve the operations, and therefore improve the revenue and the profit. And this business, it's been coasting for a couple of years, and really it's just become a distraction more than anything else. So we just wanted to get rid of it, and we found a couple of buyers who are willing to give us just over break-even price that we can, anything that we invested into the business. And as you know, I buy businesses. So we bought this business back in maybe 2021, I'm not entirely sure, maybe 2021 or 2022. And we are getting close to break even, not close to break even, more than break even for the sale of the business. Now, we wanted to sell the shares, and both of the buyers, they said that they wanted to buy the assets. And instead of negotiating too hard, we just thought, you know what, we'll just sell the shares, sell the assets. Why? Because it's more of an accounting thing. I mean, the value of the assets on the business, on the balance sheet, I should say, is and the value of what we're getting, there's not too much difference between the two. And in terms of the taxation that we're going to end up paying, it's going to be a very nominal amount. And even after taxation, we'll be able to break even on the price of what we paid for the business. It just gets rid of a headache, right? So that's why in this instance, we are happy to let go of the assets. And really and truly, if you are a multi-business owner, especially our companies are held in a holding company structure. So when you have a business which is in a holding company structure, meaning we're talking about this one business that wants to be or is going to be sold, with the holding company structure, we can move our money around within the holding company without incurring further taxation. So that's why it makes more sense for us to sell the assets of the business. Or when I say more sense, it makes sense for us to sell the assets of the business when we've got two buyers in front of us who both want to buy the assets. Now, of course, when you're coming to sell your business, you want to have competition in the sales process. If we look at, we've had multiple offers on all of our businesses, or not all of them, but a lot of our businesses. And this particular business, we've been offered lower than break even. I won't disclose exactly what the price is until the deal is done and we can start disclosing numbers. But we've had multiple offers on this particular business, and those offers have not been great. Then they've just been like, we would end up losing money if we took those offers. However, the importance of introducing competition into the sales process really helps in ramping up those numbers. If you look at any person who has sold their business and they've had multiple people who are interested in the sale of their business, then normally they've been able to increase the actual sales price that they are receiving. So that's why introducing competition and to ensure that you've got multiple people. Now, there's a certain situation. Look, if you've got a great business and someone's come over and they've offered you more than 10 times EBITDA of your business, 10 times profit of your business, really and truly, unless you know you've got something exceptionally special, you should just go and sell the business, because the likelihood of another person coming along and offering more than 10 times EBITDA is highly unlikely, especially if you've got a business which is doing less than 100 million in revenue, or even I would say less than 20 million in revenue. Actually, if you're a medium-sized business, then there are people out there. It depends where the buyers are coming from. If they want to penetrate the market, normally they'll pay over the odds for that kind of thing. You really need to look at your particular situation. But yeah, coming back to the sale of the shares or the assets, sell shares, buy assets. That's a normal sort of saying in M&A. And selling the shares is going to be your better bet. If you're so we're talking about ours is in a holding company structure, and that's why we can move money around without incurring taxation. If you are a single business owner and you only own one business, and this is your business that you've had for the last 20, 30, 40 years, whatever it may be, and someone's come along, or you want to sell the business, then you should definitely be selling the shares of the business. And as long as you're not in a desperate situation, and really you should never be selling your business, meaning leaving the sale of your business until you get to a desperate situation, meaning until you get to a desperate situation, you should try and sell before that. Then you have the option and you say, no, I don't want to sell the assets of the business, I want to sell the shares of the business. So let's take this example. Let's say you're selling your business, just to make the numbers easier, you're selling your business for £1 million, right? If you sell your business for £1 million and you sell the shares of the business, then at the time of making this video, then your total taxation is going to be 18%. Let's just make it 20%. Well, 18% of 1 million is 180,000, still easy numbers. So you sell the shares, you pay 180,000 in tax, you net whatever the difference is. What's that? 780? No, it's 820, of course. You net 820,000, right? If you sell the assets of the business, and this is your only one business, and you're not going to sell another business in the future, and you don't have other businesses or other interests, then you are going to take £1 million. You're going to pay corporation tax on that. So that's already, because it's going to be over the £250,000 threshold then you're going to pay 25% taxation. That's £250,000 gone in corporation tax, which is already higher than the £180,000 that you would have sold or you would have paid in taxation when you sell the shares of the business. So then once you've paid your 25% corporation tax there, then you're going to extract the rest as a dividend, and then you're going to be paying the 40% or 39% dividend tax when you are extracting the monies from the business there. So all of a sudden, you've just lost a huge amount of taxation, massive. I mean, it's incomparable. There's no way that you can compare the two. And that's why you should be selling the shares of your business. If there's no other reason, it's that taxation. That taxation. It's just too much. When you're selling the shares of the business, you also just let go of the liabilities. The other thing with the assets, when you're selling the assets of the business, is that because you're keeping the legal entity, you're keeping the limited company, then, or the S Corp, if you're in America, whichever corporation vehicle you have in the US, whichever country you're in, you are keeping all the potential liabilities of the business. Now, the other reason why we are okay in selling the assets of this particular business is because this particular business is a very unique situation that it doesn't employ any employees directly. So we use other companies in which to outsource employees to this particular legal entity. It's a really funny and unique situation that most business owners won't ever have, because if you're a business owner normally you've got employees working within that business as well. So there's going to be no employee liabilities. We've actually cleaned that up. I was talking to my PA today, and she told me that everything was cleaned up 5 days ago when it comes down to the, any employee situation that we had within the business. So 5 days ago, everything was cleaned up, and then we're completely ready to go. The only thing that can really stab you, and this is, as long as you've paid your taxes on time and you've paid it correctly and your VAT and so on and so on, then you shouldn't have any HMRC issues or IRS issues if you're in another country, in the US. So you really need to make sure that you're confident that you won't have any tax issues later on, because of course HMRC or IRS can still come after you because you're on the legal entity. Now, of course, the sensible thing then would be, if you're selling the assets of the business, is just to wind the corporation up, wind the legal entity up, which we're probably going to end up doing anyway. We've got another legal entity which is sitting there dormant that we can use for future asset purchases if we want to do that. But so sell your shares. If taxation is not the biggest reason, the other reason is you're selling the entire history, including all of the liabilities as well. Meaning, if, for example, as long as there's no gross misconduct from your time and you've disclosed everything to the seller, to the buyer, I should say, you've disclosed everything to the buyer, then there won't be any warranty claims which will be exercised against you as an individual. Because when you're selling your business, one of the 4 P's that I talk about is preservation. And that means preservation of your mental sanity, but also preservation of the monies that you receive after you've sold your business. So preserving what you have sold your business for, that monies that you have received, is extremely important when you're selling your business. And HMRC is your biggest threat. Legal cases, either from customers or whatever it may be, is your biggest threat. And when you're selling the shares, it's harder for that to come back on you. It's more difficult for the buyer who's buying your business to bring that back on you, unless they can substantiate that is because of negligence and you have not disclosed that to the buyer when they are buying your business. So that's a nutshell. I mean, we could go on massively. I just want to make this short one, that you should be selling your shares of the business. But in this particular case, because we've got a holding company, we've got, there's not going to be a huge amount of tax to pay on the sale of the shares of this business or sale of the assets of the business, because we'll be able to pay a very small amount of corporation tax because of the difference between the value of the assets on the balance sheet and the purchase price that we're getting, or the sales price that we're getting, and that we have a holding company in which you can move money around without incurring further taxation. And in fact, when we receive that funds, then we'll be able to move that money elsewhere and do or conduct other business with that funds. But of course, you're a single business owner, you want to extract as much value as possible and keep that for yourself. If you want to find out more about selling businesses, then click this video which is popping up, and I'll see you in the next video.